Hello, and welcome to Credit Compass, your guide to navigating European credit markets. Another volatile week with markets swinging on headlines around the Iran conflict, whether we're nearing resolution or facing a more prolonged disruption. Today, we'll unpack how that uncertainty is shaping interest rate expectations through the dual lenses of inflation and growth. And we'll also look at a potential consumer boost in the UK stemming from auto loan compensation and a recovering housing market. Finally, what recent moves in yields and spreads mean for credit investors. All right, let's dig in. Let's start with interest rates. Europe is facing what looks like a renewed energy shock, as we have highlighted a number of times, but it's important to distinguish this from the 2022 crisis triggered by Russia's invasion of Ukraine. Back then, Europe was heavily reliant on Russian gas and entered this shock with a strong economic momentum, tight labor markets, and significant monetary stimulus still in place from the pandemic. Fast forward to today, and the setup is quite different. Europe has made meaningful progress on energy diversification, expanded renewables, brought inflation down materially from its peak, but now it enters this new shock from a much weaker starting point. Growth is subdued, labor markets, while still relatively tight, are beginning to loosen, particularly in Germany and the UK, and monetary policy is no longer accommodative. Rates have already been normalized following the last inflation cycle. So, while is still fundamentally a supply driven inflation shock, typically something central banks would look through, the relative context does matter. That raises the key question: why is the ECB sounding more hawkish than you might anticipate? Christine Lagarde's remarks at the ECB Watchers Conference on March 25th struck a notably firm tone. While she stopped short of explicitly signaling rate hikes, she emphasized several risks that are clearly shaping the ECB's reaction function. First, sustained increases in energy prices could reverse earlier progress on disinflation. Second, the ECB is modeling quite severe scenarios in its worst case where inflation could exceed 6% and remain above target for a prolonged period. And third, there's a growing concern that persistent shocks could begin to unanchor inflation expectations. This, in particular, I think is key, making inflation more self reinforcing and harder to control. In other words, this is as much about credibility as it is about current inflation. Lagarde made it clear that failing to respond to inflation overshoots risks confusing the public and undermining trust in the ECB's commitment to price stability. So even if the ECB ultimately does look through some of this shock, it is actively managing expectations, and that alone is pushing rate expectations higher in the near term. However, there is an important counter force that is developing. The longer this energy shock persists, the more the narrative shifts from inflation to growth. Higher energy prices act as a tax on both consumers and businesses, squeezing margins and reducing disposable income. Over time, that leads to demand destruction and weaker growth expectations, forces that are typically supportive of lower, longer term rates. So, we're effectively in a tug of war, near term inflation risk pushing rates higher versus medium term growth concerns pulling them lower. Recent inflation data across Europe is beginning to reflect this dynamic. March prints have broadly come in higher across the region. Spain kicked things off with an increase, though slightly below expectations, and was followed by similar rises in Germany, Italy, France, Austria, Belgium, Ireland, Poland, and the Netherlands. Most of these readings remain above the ECB's 2% target, with France and Belgium as the exceptions. At the aggregate level, Eurozone inflation came in at 2.5%, up from 1.9% in February, so a meaningful acceleration, even if slightly below consensus expectations. Core inflation, however, edged down to 2.3% from 2.4%, suggesting that underlying price pressures are not yet reaccelerating, but is still early in this new energy cycle. One key risk that I've highlighted is behavioral. Businesses, having recently experienced an energy driven inflation shock, may be quicker to pass through higher costs this time around. Pricing power, at least for now, remains somewhat intact in parts of the economy, particularly as growth had been showing tentative signs of improvement. The danger is that this becomes self-limiting. If too many firms raise prices too quickly, it could accelerate the slowdown in demand, bringing forward the growth drag that we had discussed. Now, with all that, turning to the UK, where there actually may be a modest but meaningful offset. The Financial Conduct Authority has finally ruled on compensation related to missold auto loans. While the total liability has been reduced from earlier estimates, the key point is that payouts could begin as early as June. From a macro perspective, this acts as a quasi-fiscal stimulus, but without direct government spending. It effectively injects cash into households, supporting consumption at a time when growth is expected to remain weak. According to the OECD, the UK is projected to have one of the slowest growth rates among developed economies, second only to Italy. What makes this particularly interesting is the distributional effect. These payments are likely to skew toward lower and middle-income households, segments with a higher marginal propensity to consume. In other words, a larger portion of this money is likely to be spent rather than saved, amplifying its economic impact. However, should the current FCA ruling be challenged with further legal proceedings, the payout timeframe could be pushed out further. There are also some recent tentative signs of stabilization in the housing market. Net lending and mortgage approvals improved in February, just ahead of the spring buying season. This has provided some support to house prices, with a nationwide index showing a 2.2% increase, well above both expectations and the prior month. That said, this strength may prove temporary, given the data relates to the pre-Iran period when rates were on the decline. If rates remain elevated or move higher in response to inflation risk, affordability pressures could quickly reassert themselves. So, what does all this mean for credit markets? Well, periods of volatility tend to slow primary issuance as it becomes more difficult to price deals when markets are moving sharply day to day, and we've seen that recently. However, it's worth noting that the first 2 months of the year were exceptionally strong, meaning first quarter issuance still looks robust overall. Behind the scenes, a pipeline of deals is building, waiting for more stable conditions. Even in this environment, some transactions are getting done. One notable example is financing tied to AI infrastructure. European AI company Mistral secured roughly 750 million euros in funding for a new data center backed by a consortium of European banks. This follows closely on the heels of a 700 million euro securitization for a data center near Amsterdam. These deals highlight a structural theme. Europe is actively investing to close the gap with the US in AI capabilities, and credit markets are playing a central role in funding that expansion. In secondary markets, we're seeing increased volatility at the longer end of the yield curve as investors reassess the balance between inflation and growth. At the same time, credit spreads have been widening, particularly in lower-rated segments, reflecting rising uncertainty and more cautious risk appetite. We expect this dynamic to persist in the near term, but there's an important implication for investors. This combination of higher underlying yields and wider spreads means that all-in yields are becoming increasingly attractive, now in many cases exceeding equity dividend yields across European markets. For investors willing to tolerate volatility, that begins to shift the relative value proposition back towards credit. Looking ahead, this environment is unlikely to resolve quickly. Even if geopolitical tensions ease, the after effects, particularly in energy markets, may linger. And while spreads have already moved wider, markets still appear to be pricing in a relatively swift resolution. That leaves room for further adjustment if the situation proves more persistent. For now, the prevailing trend remains one of gradual widening, with day-to-day moves driven heavily by headlines and sentiment. That's all for this week's edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Till next time, stay curious, stay informed, stay resilient. Let Credit Compass help guide your way.